So you started investing, that's incredible. You bought some stocks, maybe some crypto. But be honest, you have that insane feeling in the back of your head that you're just guessing. A scary headline about inflation pops up and boom, your finger is hovering over the sell button, ready to lose everything. Then your friend texts you about some hot new stock that's supposedly the next big thing, and you get that crazy FOMO, that feeling that you have to jump in right now. This feeling, this one single feeling, is the only thing that separates people who build actual generational wealth from people who are just gambling in the market. And it all comes down to one behavioral mistake. It's not about what stocks you pick, and it has nothing to do with timing the market perfectly. In this video, I'm going to show you exactly what that mistake is. And more importantly, I'm going to give you a framework to destroy it, which might be the most important thing you do for your financial future in 2026. This isn't just about making more money, it's about getting your sanity back. Alright, let's see if this is you, be honest. You wake up and before you even have your coffee, you're checking your portfolio. It's up 2%. Yes, a little shot of dopamine hits. It's gonna be a good day. Later that afternoon, you see a news alert. Markets tumble on interest rate fears. You check again, now you're down 1.5%. Your stomach just drops. The good feeling is gone, replaced by pure anxiety. You're scrolling through TikTok and see some influencer with a rented Lambo talking about a new altcoin that's guaranteed to go 100x. You see screenshots of their insane gains. You feel that jealousy and a crazy urge to buy in, not because you get the tech, but because you are terrified of being left behind. This is FOMO, the fear of missing out, and it is one of the most destructive forces in investing, ever. Or maybe you see a stock that has already skyrocketed 300% in the last 6 months. You think, wow, this thing is a rocket, and you jump in hoping for the next 300%. But here's the secret. By the time a stock is famous, the big money has already been made. You're not early, you're the exit plan for the people who got in before you. This is what I call reactive investing. You're not the captain of your financial ship. You are literally a leaf in the wind, tossed around by daily news, social media hype, and your own feelings. Every single day is a test of your decisions. Every red day feels like you failed, and every green day feels like you cracked a code that you know you haven't. This is not investing. This is a super stressful, full-time job you never signed up for, with the worst boss in the world, your own emotions. The constant deciding is exhausting. Should I sell? Should I buy more? Was that a mistake? It leads to overtrading, racking up fees and taxes that eat your returns. And this is a huge problem. A 2021 Magnify Money survey found that a mind-blowing 66% of investors made an impulsive decision they regretted. You are not alone, but you need to see this for what it is. You are literally sabotaging yourself. The reality is this approach almost never works. It's a recipe for buying high because of greed and selling low because of fear, the complete opposite of how you build wealth. Most beginners lose money not because they're unlucky, but because they panic and follow hype. This reactive state is the problem. Now let's talk about why it's so dangerous. I'm about to tell you a story about two investors. Alex and Ben both start investing in 2026 with $10,000. This is literally the difference between being broke and being a millionaire. Alex is a classic reactive investor. He's smart, he reads the news 24/7. When the market is booming, he feels like a genius. He sees tech stocks soaring and throws more money in, chasing the rocket. Then global uncertainty hits and the market drops 15%. Headlines are screaming recession, fear takes over. Alex remembers stories of people losing everything and panics. He sells just until things calm down. He feels relieved, thinking he saved himself from more losses. The market is choppy for a few weeks with huge down days and huge up days. Alex is waiting for the perfect signal to get back in, but the market recovery, when it comes, is fast. By the time Alex feels confident enough to buy again, he has missed the biggest rebound days. He didn't just lock in his losses, he sat on the sidelines while the market exploded upwards. He played himself. But then there's Ben. Ben is a systematic investor. He creates a plan before he invests his $10,000. He's investing for retirement in 30 years and chooses a couple of low-cost index funds. He sets up an automatic investment of $500 every single month. When that same 15% drop happens, he feels the exact same fear as Alex. His gut screams at him to sell, but he does nothing. He trusts his system. His automatic $500 investment goes through, buying even more shares at a lower price. He literally bought the dip without even thinking about it. Years later, Ben's portfolio has crushed Alex's. Alex's $10,000, destroyed by panic selling and scared rebuying, has barely grown. Ben's $10,000, left to compound and consistently fed, has grown into a massive amount of money. This is not a fairy tale, this is a reality backed by decades of data. The research firm DALBAR has been studying this for over 30 years, and their findings are insane. They consistently find a huge gap between the market's returns and what average investors actually get. Why? Because of people like Alex trying to time the market, selling in panic mode and missing the biggest wins. Let's put some hard numbers on this because this is crazy. A well-known JP Morgan analysis looked at a 20-year period and found that if you missed just the 10 best days in the stock market, your total return was cut in half. And get this, the market's best days often happen within a couple of weeks of its worst days. So when you panic sell to avoid the worst, you almost guarantee you'll miss the rocket ship back up. And the mental cost is just as bad. The constant stress, regret, and anxiety, it's an emotional nightmare. A 2026 survey from the Motley Fool found that 41% of investors feel anxious about their investments at least some of the time. This isn't building a better future, it's sacrificing your happiness today for a strategy that is designed to fail. So what is the single biggest mistake? It's letting the market be your boss instead of you being the boss. The reactive investor asks, what's the market doing today and how should I react? The proactive, wealthy investor asks, what did my plan say I should do today? And 99% of the time, the plan says, do nothing. Let the system work. Conquering this mistake isn't about becoming a robot. It's about building a system that literally protects you from yourself. It's about making the right decisions automatic and the wrong decisions impossible. Here is the simple 3-part framework to do it. I call it the proactive investor framework. Do not skip this part. Part 1. Build your fortress, the financial foundation. Step 1. Before you even think about investing, you need to build a fortress, an actual financial fortress. This fortress has 2 massive walls. First, an emergency fund. This is non-negotiable. It's a separate savings account with 3 to 6 months of your essential living expenses. If your income is unstable or you have a family, maybe even 12 months. Bankrate's reporting has consistently shown how many Americans are one step from disaster. One recent survey showed nearly 60% of Americans couldn't even cover a $1,000 emergency expense. Don't be that person. An emergency fund is your superpower. It's what lets you see a 20% market drop and not even flinch because your rent is paid. It's the money that lets you sleep at night. Second, destroy high-interest debt. I'm talking about credit card debt, personal loans, anything over 7-8%. Paying off a credit card with a 21% APR is like getting a guaranteed, risk-free 21% return on your money. You will never find that in the stock market. Trying to invest while you have credit card debt is like trying to fill a bathtub with the drain wide open. Build that fortress first. Part 2. Define your mission, your investment strategy. Step 2. Now that your fortress is built, it's time to attack, but an army without a mission is just a mob. You need to define your investment strategy before you invest a single dollar. This means answering 2 huge questions. First, why are you investing? Is this for retirement in 40 years? A down payment on a house in 10 years? Your timeline changes everything. Money you need in 5 years should probably not be in stocks. Money you won't touch for decades can and should ride out any storm. Second, how will you invest? For almost everyone starting out, the best strategy is not to search for the needle in the haystack. Instead, I want you to literally buy the entire haystack. This means investing in low-cost, broadly diversified index funds or ETFs. These funds hold hundreds or thousands of stocks, letting you own a tiny piece of the entire market like the S&P 500. This gives you instant diversification and historically provides insane returns over the long term. Your mission also includes how often you invest. Instead of guessing the perfect time to buy, you're going to use a cheat code called dollar cost averaging. This just means investing a fixed amount of money at regular intervals like $500 on the first of every month no matter what. When the market is high, your $500 buys fewer shares. When the market is low, that same $500 buys more shares. It automates buying low and stops you from dumping all your money in at the absolute peak. It's an automatic win. Part 3. Automate your execution, set it and mostly forget it. This is the final, most important step that ties it all together. You take the decision-making out of your own hands. You've built your fortress, you've defined your mission. Now you automate everything. Go into your bank account right now and set up an automatic transfer to your brokerage account every single payday. Then, go into your brokerage account and set up automatic investments into your index funds. The entire process should happen without you lifting a finger or making a single emotional decision. Your wealth-building machine is now running 24/7 in the background. It turns investing from a source of daily stress into something as boring as your electricity bill. Your job is no longer to watch the market. Your job is to protect this system. Your job is to live your life, grow your income, and let the machine do the heavy lifting for you. Check your portfolio maybe twice a year, not daily. And resist the urge to mess with it. Do not touch it. This shift in mindset from a reactive gambler to a proactive owner is the most important step you will ever take in your financial life. It's the difference between hoping for a lucky break and building a predictable path to becoming wealthy. It's about trading short-term adrenaline for long-term peace of mind. So I have a challenge for you. In the comments below, what's the one headline or piece of news that tempted you to make a crazy reactive decision recently? Drop it in the comments. Let's talk about how to ignore all that noise. And if this video helped you reframe how you think about investing, do me a favor and destroy that like and subscribe button. It helps the channel out more than you know. Remember, the goal isn't to be the smartest investor in the room. The goal is to be the most disciplined. Build your fortress, define your mission, and automate your execution. Do that, and you will have conquered the single biggest mistake new investors make in 2026. Thanks for watching, and I'll see you in the next one.